There is a moment in financial history when optimism becomes a weapon, when prosperity turns into anesthesia, when a nation convinces itself that the rules no longer apply. America is standing in that moment right now because the pattern unfolding in the U.S. economy today, the surging markets, the record leverage, the insider exodus, the artificial prosperity built on debt is not new, it is not unique, and it is not accidental. It is the exact same blueprint that drove the Roaring '20s into the Great Depression. The numbers match, the behavior matches, the psychology matches, only the technology is different, and that's the most dangerous part. In 1929, it took years for the bubble to inflate. In 2025, it takes months. Back then, speculation spread from newspapers to crowded brokerage halls. Today, it travels through apps, social feeds, and algorithmic hype engines that can turn any stock into a religion and any asset into a mania. People believe they're richer than ever, but the wealth is synthetic, engineered by cheap credit, financial engineering, and a Federal Reserve trapped in its own policies. This is not a prediction. This is not fear-mongering. This is mathematics. The same mathematics that vaporized 89% of the market between 1929 and 1932. And the twist that almost nobody sees, America isn't just repeating the 1929 boom, it's repeating the sequence, the same domino chain that always ends the same way, violent deleveraging. Because once a system builds enough debt, enough speculation, and enough illusion, the crash stops being a risk. It becomes an outcome. The only question left is simple. How far into the cycle are we? And when you trace the data, the credit levels, the market structure, the insider behavior, the answer is unsettling. We're not at the beginning. We're not in the middle. We're at the stage right before everything breaks. To understand why, we need to go back. Back to the decade that America believes it conquered, but never learned from. To understand the blueprint, you have to return to the moment America first created it, a decade that looked unstoppable, modern, invincible, a decade that felt almost identical to today. The year is 1920. The First World War has ended. European empires lie in ruins. And for the first time in its history, the United States emerges not as a debtor, but as the world's dominant creditor. Money flows into American banks. Factories built for the war shift to civilian production. Industrial output surges. Cities expand at a pace unseen in modern history. But beneath the surface, something else is happening. The Federal Reserve, only 7 years old, is still learning what it means to control the money supply. In 1921, as the economy enters a sharp post-war recession, the Fed makes a pivotal decision, one that will ignite the greatest boom America had ever seen. They cut interest rates, not cautiously, not modestly, but aggressively, pushing the discount rate down to 3%. Banks follow. Credit becomes cheap, credit becomes easy, and for the first time in American life, consumption becomes democratized. You don't need to save for the car, the refrigerator, the radio. You can buy it now and pay later. This is where the psychology shifts. Cheap credit doesn't just stimulate spending, it rewires incentives. When borrowing is nearly free, why wait? Why invest in slow, productive businesses when leveraged speculation can double your wealth in months? By 1924, the transformation is visible everywhere. Streets fill with automobiles, appliances fill living rooms, suburbs expand. To the average American, it feels like progress, prosperity, the emergence of a modern superpower. But in the shadows of this prosperity, the structure of the economy is changing. Manufacturing is strong, but credit is stronger. Innovation is real, but speculation is growing faster. Wages rise, but stock prices rise far more. By 1925, the stock market is no longer an arena for bankers and industrialists. It becomes a national obsession. Teachers, mechanics, clerks, small shop owners, millions enter the market for the first time, encouraged by newspapers, by neighbors, by the illusion of effortless wealth. And the mechanism that makes all this possible is one that will define every future bubble, including the one America is living through today: margin debt. You walk into a brokerage with $1,000. The broker lends you $9,000 more. With $10,000 of stock, a 20% gain doubles your money. A 10% loss wipes you out. This structure, leverage stacked on leverage, spreads through the entire financial system. Brokers borrow from banks. Banks borrow from other banks. Industrial corporations, flush with cash. lend to brokers at double-digit rates because the returns are irresistible. And by 1927, the boom mutates into a mania. The Fed cuts rates again. Under pressure from struggling Europe, liquidity surges, stock prices melt upward, investment trusts explode, funds that borrow, buy stocks, then trade at premiums so large that people start buying trusts that own trusts that own trusts. A pyramid of illusions, built on borrowed money, rising on borrowed time. But here's the part that people forget. None of this felt dangerous in the moment. It felt rational. It felt deserved. It felt permanent. America believed it had engineered a new kind of prosperity, one that could never end. The same belief investors hold today. And just like today, beneath the surface of that optimism was a silent equation, a hidden instability growing so large that the smallest shock could collapse the entire structure. To see how dangerous this blueprint really is, we need to look at how it has repeated, not once, but across multiple countries and multiple centuries. By the late 1920s, America was convinced it had transcended economic gravity. Stocks only went up. New technology justified new valuations. The Federal Reserve believed it could manage speculation better than any central bank before it. Sound familiar? But beneath the glow of prosperity, the system was rotting. Margin loans had grown eightfold. Investment trusts were pyramids of leverage. Funds that owned funds that owned funds. Corporations diverted working capital into the call money market because lending to speculators earned more than manufacturing. Every level of the economy, households, corporations, banks, was leaning forward on the same assumption: prices will rise forever. And when the first cracks appeared, the leverage didn't just unwind, it detonated. A 13% drop in stocks triggered margin calls. Margin calls triggered forced liquidation. Forced liquidation triggered panic. From 1929 to 1932, the market didn't correct. It collapsed 89%. Not because of bad luck, because the system had been engineered to collapse the moment the upward pressure stopped. This is the blueprint, and it didn't stay in America. Case Study 2, Japan. 1989, the wealth illusion that never returned. Japan's post-war miracle was real. Factories rebuilt, exports surged, technology flourished. But the bubble that followed was not real wealth. It was credit masquerading as prosperity. By the mid-1980s, the Bank of Japan kept interest rates artificially low to suppress yen appreciation. The result? A flood of liquidity that poured into stocks and real estate at the bubble's peak. The land beneath the Imperial Palace in Tokyo was valued higher than the entire state of California. Banks lent on collateral that was rising only because banks kept lending. Corporations borrowed to buy their own shares. Households speculated in condos that doubled in price every few years. It was the same psychological loop as 1929. Cheap money, speculative boom, belief in a new era. But when the Bank of Japan raised rates in 1989, the illusion evaporated. Stocks fell 60%. Real estate fell 80%. Japan entered a deflationary spiral it has never escaped. A 30-year economic winter. Why? Because once an economy becomes dependent on asset inflation, a slowdown doesn't just hurt feelings. It destroys balance sheets, collateral values, and the banking system's foundation. Japan wasn't unlucky. It followed the same blueprint. Case Study 3, the Global Financial Crisis. 2008, the 21st century version of 1929. By 2006, the world believed finance had become too sophisticated to fail. Risk was spread out. Housing prices never fell nationally. Wall Street had engineered stability. In reality, subprime mortgages were 1929 margin loans dressed in new language. CDOs were the modern investment trusts, layers of leverage stacked so deep that nobody could see the foundation. Home buyers borrowed with no income verification. Banks borrowed from shadow lenders. Shadow lenders borrowed from money market funds. Every dollar in the system was multiplied through derivative exposure. And just like 1929, when prices stopped rising, the math turned predatory. Defaults rose, collateral fell, derivatives detonated, and within days, the world's largest financial institutions were insolvent. The U.S. avoided another Great Depression only because the Federal Reserve printed liquidity on a scale no central bank had ever attempted. But here's the critical point. They didn't fix the system. They inflated a new one. The leverage moved from households to corporations. The excess moved from mortgages to tech valuations. The debt moved from banks to the federal government. The blueprint survived and accelerated. The pattern behind all three. Look at 1929. Look at Japan. Look at 2008. Each follows the same six-step architecture. Cheap credit floods the economy. Speculation replaces production. Asset prices disconnect from fundamentals. Leverage becomes the backbone of growth. A small shock triggers forced deleveraging. The collapse is mechanical, not emotional. This is the cycle America is repeating now, but with more debt, more technology, and more global interconnection than any prior empire. Each historical case wasn't an accident. It was a system hitting its mathematical limit. And today, the U.S. economy has already crossed into the phase where the boom no longer self-sustains. It must be actively inflated to survive. The next question is inevitable. What does this blueprint look like in the United States right now? And why are the signals more dangerous than any point since 1929? If history is the blueprint, then the United States in 2025 is the latest empire following it line by line. Every signal, credit markets. Insider behavior, valuations. Debt structure points to one conclusion. America has entered the late stage of the boom, the point where the system stops expanding naturally and must be artificially propped up to survive. This is exactly where the U.S. stood in 1928. 1. The leverage is back, but bigger. In 1929, margin debt peaked at about 8% of U.S. GDP. In 2025, margin debt hovers near $800 billion, and that's just the visible portion. The real leverage hides in options markets, where notional exposure has exploded to trillions. Total return swaps, used by hedge funds to multiply positions off balance sheet, structured products tied to tech stocks, shadow banking lenders providing margin-like leverage without reporting requirements. In 1929, leverage was dangerous. Today, it is systemic. Investors no longer own assets. They rent exposure to them through synthetic leverage layered across multiple institutions. When prices fall, the liquidation chain will be faster and more synchronized than anything in 1929. 2. Corporate America is a debt machine after the 2008 crisis. Households deleveraged, but corporations didn't. Corporate debt has surged past $12 trillion, much of it borrowed to buy back shares, inflate earnings per share, maintain valuations detached from reality. More than 20% of U.S. companies now qualify as zombies, firms whose operating income cannot cover their interest payments. These corporations survive not from profit, but from refinancing, borrowing new debt to pay old debt. This is the same dynamic that fueled Japan's collapse in 1989. When credit tightens, zombies die first, and when they die, credit markets freeze. 3. Insider behavior is sounding the alarm. In every major bubble, 1929, 1989, 2000, 2008, the people closest to the system exited quietly before the collapse. The same pattern is unfolding now. Warren Buffett is holding $325 billion in cash, the largest cash hoard in market history. Jeff Bezos has sold over $13 billion in Amazon stock. Mark Zuckerberg has sold billions in Meta shares. More than 1,000 U.S. executives executed large sales throughout 2024-2025. Insider selling is higher than at any time since 2007, when the people running the system don't want exposure to the system. That is not a coincidence. It is a signal. 4. The Fed is trapped in every historical bubble. Central banks play the same role. They inflate the boom. They lose control. They scramble to contain the fallout. But 2025 is the first time in U.S. history where the Federal Reserve is trapped between inflation and insolvency. Here's why. U.S. federal debt has exceeded $37 trillion. Annual interest payments are approaching $1.2 trillion. Refinancing this debt at current rates is mathematically impossible. If the Fed keeps rates high, the Treasury becomes insolvent. If the Fed cuts rates, asset bubbles accelerate and inflation returns. In 1929, the Fed misunderstood the bubble. In 2025, the Fed understands it, but cannot escape it. 5. Market valuations are untethered from reality. Look at the fundamentals. GDP growth is slowing. Corporate earnings are stagnating. Productivity gains are weak. Real wages are flat, yet the stock market sits at or near all-time highs. The Buffett indicator, total market cap to GDP, sits around 185%. Deep into overvaluation territory. Buffett himself has said that anything above 120% represents extreme risk. We are far past extreme, and the concentration is unprecedented. 7 tech companies account for almost 30% of the entire S&P 500's value. In 1929, RCA played this role, a single stock representing the future. Today, The Magnificent Seven act as the modern RCA, propped up by narratives, passive flows, and algorithmic buying. When concentration becomes this extreme, the system is no longer broad, it becomes brittle. 6. The consumer is exhausted. The illusion of strength depends on the American consumer, but the numbers show exhaustion. Credit card debt, 1.3 trillion, record delinquencies rising at the fastest pace since 2008, savings rates near historic lows, real purchasing power falling. In 1929, consumers were stretched thin by installment credit. In 2025, they are stretched thin by revolving debt at 22% interest. The details change, the mathematics doesn't. 7. The blueprint is already in motion. Here's the uncomfortable truth. The United States is not approaching the pattern that defined past collapses. It is already deep inside it. Overextended credit, synthetic leverage, executive liquidation, central bank trapped, public belief in a new era, asset prices disconnected from reality. This is stage 5, the phase where everything looks strongest right before the structure gives way. But the most dangerous part is not the leverage, not the debt, not the valuations. It's the belief that America is different, that the system is too advanced, too modern, too engineered to collapse. Every empire makes this mistake, and every one of them eventually discovers the same truth. When the math breaks, the narrative breaks with it. To understand what happens next, and why this cycle may collapse faster and harder than 1929, we have to look at the accelerants unique to the modern era. Every collapse in history follows the same architecture, but every new collapse happens faster, not because humans change, but because the machinery we build multiplies our mistakes. The forces accelerating the next downturn are unlike anything the world faced in 1929, or in 1989, or in 2008. This time, the boom isn't just inflated by credit, it's weaponized by technology, global interdependence, and the largest debt load in human civilization. The blueprint hasn't just returned, it has evolved. 1. Technology turns manias into flash fires. In 1929, speculation spread through newspapers and crowded brokerage halls. Information lagged. Rumors took hours or days to reach investors. Today, the market moves at the speed of algorithms. AI trading systems react in microseconds. Retail investors trade with a swipe. Social media converts speculation into mass movements instantly. A single viral narrative can trigger millions of trades, billions in capital shifts, automatic liquidations, volatility explosions. The system is no longer human-paced. It is machine-amplified. When the correction begins, it will not take months like 1929. It will take minutes. 2. Passive investing has created a one-way market. In 1929, investors consciously bought stocks. In 2025, they buy indexes, and the indexes buy everything automatically. More than 50% of U.S. equity flows come from passive funds. S&P 500 ETFs, target date retirement funds, automated allocation models. This creates a structural fragility. Stocks rise because passive funds buy them. Passive funds buy them because stocks rise. Valuations detach from fundamentals. It is a self-reinforcing loop until it reverses. When selling begins, ETFs will not discriminate. They will dump the good, the bad, and the systemically important all at once. This has never existed in any previous crash. It ensures that the next downturn will be broad, synchronized, and violent. 3. Globalization has made crises instantaneous. In 1929, the world economy was connected but not integrated. Today, the U.S. sits at the center of a global financial web. European banks hold trillions in U.S. assets. China holds trillions in dollar reserves. Emerging markets depend on dollar liquidity. Global trade contracts are priced in USD. Foreign pension funds own U.S. equities and bonds. When the U.S. stumbles, the world doesn't follow. It implodes with it. A downturn in American markets now freezes global dollar funding, triggers emerging market currency collapses, destabilizes European banking, vaporizes sovereign reserves, disrupts global supply chains. The blueprint is no longer national. It is planetary. 4. Derivatives are the hidden fuse. In 2008, the problem was mortgage derivatives, roughly $60 trillion in exposure. In 2025, total global derivatives exceed $600 trillion, an order of magnitude larger. Derivatives aren't inherently dangerous until volatility spikes. Then every contract becomes a margin call. Banks, hedge funds, insurers, pension funds, every major institution is tied to these instruments. A small move in interest rates, currencies, or stock prices can trigger. Collateral shortages forced liquidations, liquidity spirals, cross-asset contagion. In 1929, leverage was visible. In 2025, leverage is buried inside contracts no regulator fully understands. The system is strong only as long as nothing moves. When it moves, it fractures everywhere at once. 5. The U.S. government is more indebted than any empire in history. This is the accelerant no past collapse had to face. The U.S. federal debt is now $37 trillion. Interest payments alone are approaching $2 trillion per year. The Treasury must continuously borrow just to pay interest. This is late-stage empire mathematics. In 1929, the government had the capacity to respond. In 2008, it had room to cut rates and expand the balance sheet. In 2025, it has neither. A crisis today would force the Federal Reserve to choose between saving markets, cutting rates, printing money, preserving the dollar, controlling inflation, protecting reserves. It cannot do both. The next downturn won't just be a financial event, it will be a sovereign event, one that tests the credibility of the U.S. fiscal system itself. 6. The illusion is larger, and so is the shock when it breaks. In 1929, the illusion was margin prosperity. In 2008, the illusion was housing prosperity. In 2025, the illusion is everything. Inflated tech valuations, inflated corporate earnings, inflated consumer strength, inflated real estate markets, inflated government guarantees. The country is floating on narratives that require constant upward motion. When the trend reverses, the adjustment isn't emotional, it's mechanical. The same blueprint that erased trillions in 1929, that froze Japan for 30 years, that nearly broke the global banking system in 2008, will accelerate more rapidly than anyone alive has ever seen, because every accelerant points in the same direction. When this market breaks, it won't unwind, it will snap. And now, the only thing left to answer is the final question. What does the endgame look like? What is the inevitable outcome of a system running the 1929 blueprint in a world 10 times more leveraged? There is a moment in every financial cycle when momentum becomes gravity, when optimism becomes denial, when the system stops expanding and begins collapsing under the weight of its own design. The United States has reached that moment, not because of a single shock, not because of a crisis yet to appear, but because the architecture of the boom, the credit, the leverage, the passive flows, the sovereign debt load now guarantees the shape of the bust. History isn't offering a warning, it's offering a mirror. And what the mirror shows is bleakly consistent across 6 centuries of empires. The math always wins. The boom era is built on 3 assumptions. Asset prices can rise faster than income. Debt can expand faster than GDP. Liquidity will always be available when needed. Those assumptions work on the way up. They implode on the way down. Because once valuations disconnect from fundamentals, once the system depends on constant credit creation, once investors require perpetual inflows just to maintain prices, the collapse isn't a possibility. It becomes a schedule. This is the same trap that swallowed Portugal, the Dutch Empire, Britain, Japan, and every reserve currency before the dollar. America is not the exception. It is simply the latest participant in the sequence. The end of every boom looks the same. History shows the same ending. Every time. Stage 1, asset prices stall. Stage 2, liquidity thins. Stage 3, forced deleveraging begins. Stage 4, collateral values fall. Stage 5, margin structures implode. Stage 6, the system resets violently. At first, nothing looks wrong. Prices dip slightly. Optimists call it healthy. Analysts insist the fundamentals are strong. The Fed claims everything is under control. Then something small breaks. A hedge fund, a liquidity mismatch, a credit event, and the selling begins. But in a market built on leverage, selling doesn't release pressure, it accelerates it. Prices fall, leverage unwinds, volatility spikes, liquidity vanishes, more selling. This is the cascade that destroyed 1929. This is the cascade that crushed Japan. This is the cascade that nearly ended the global system in 2008. And the cascade waiting for America now is sharper, faster, and more synchronized than any of them. The Fed cannot save this one. For the first time in modern U.S. history, the Federal Reserve faces a trap with no exits. To stop the collapse, it must cut rates. But cutting rates reignites inflation, erodes the dollar, and destabilizes treasury markets. To defend the dollar, it must keep rates elevated. But high rates guarantee that corporations, consumers, and the government itself cannot roll their debts. Either choice triggers the same outcome, a sudden repricing of everything Americans believe is permanent. The Fed doesn't control the cycle anymore. It only controls the timing of the final break. The blueprint is complete. Every signal has aligned. Decadent valuations, record leverage, exhausted consumers, indebted corporations, trapped central banks, brittle global interdependence, insider liquidation, public euphoria. This is the late-stage moment in every empire's financial cycle, the point where denial peaks right before the shock arrives. The United States isn't entering the blueprint, it is finishing it. And when the shock comes, it will not feel like a crash at first. It will feel like friction, a slowing, a hesitation, a sudden, sharp absence of liquidity. Then the unwind begins, and the unwind will not be gentle. The inevitable conclusion: people ask how a system this large could fail. The answer is simple. It fails the same way every empire's economy fails, suddenly, then completely. Not because the world loses faith in America, but because America loses faith in its own illusions. The boom was engineered, the bust is mechanical. And the cycle is older than the country itself. This is the blueprint. This is the sequence. This is the mathematics. And now, the pattern is already in motion.